If you drive through an industrial park right now, you'll see a lot of For Lease signs. There's a lot of vacancy right now, but it's not evenly distributed. In fact, some markets are doing much better than others, and different sectors of industrial are actually doing quite well. To help explain this further, I asked Adrian Ponsen, CoStar's Director of US Industrial Analytics, to shine some light on the topic. Stay tuned until the end as well, because I have a point about the market which is absolutely imperative. So the first thing we need to do is separate industrial real estate into subcategories, and to keep it simple in this video, I'm going to use big box warehousing and small bay industrial. The terminology can vary, but I'm going with the definition CoStar used in a recent report for big box warehousing being buildings over 100,000 square feet. And let's tee this up by showing how the number of these buildings, which have been vacant for at least 18 months, has hit a record high.
This number has really spiked over the past year or two. At the same time, the growth in tenant demand for those properties was really strong. It was really impressive. It grew by about 15%, or about 1.5 billion square feet, but that still leaves a delta of about 400 to 500 million square feet of additional vacant space that has accumulated over that 4-year period.
While demand for logistics space increased dramatically from 2020 to 2022, developers simply added supply at a pace that exceeded the demand.
It's a pretty safe bet that this number is, that this chart, that line that you see in this chart, is just going to keep going up at least over the next few quarters. And the reason for that is that, in order to have been vacant for 18 months, the building has to have existed for 18 months. So if you go 18 months back now from today, that puts you, right around the fall of 2023. But there were still a lot of additional buildings that delivered at the very end of 23 and the first half of 24, when leasing was even weaker than these properties you're seeing in the chart delivered. And so the number's already at record highs, but we can expect it to keep moving up, at least in the near term.
There are reasons to be optimistic down the road, but as Adrian explains, it could still be a bumpy 2025.
These big box leases, you're typically looking at leases that are at a minimum, 3 or 4 years, but usually significantly longer than that, 5 to 10. And so they have to be very careful about locking in a rent. If they lock in a rent that's well below, their construction costs, and doesn't allow them to recapitalize the building at a value that would exceed, their debt costs, then they're not going to do that unless they absolutely have to. And they may want to wait, especially since most of these companies are well capitalized. They may they may be totally willing to allow these buildings to sit vacant for another year or two. No one knows for sure about that. I don't know exactly how all this is going to play out, but my goal is, everybody knows that there is a sizable volume of these projects that have been sitting vacant for a while. And my goal is to just kind of provide more transparency into where these buildings are concentrated, so that as we start thinking about, okay, how does this play out as these buildings start approaching 2, maybe 3 years of vacancy.
The next graph that Adrian shares shows how these vacancies are clustered in high population areas and are primarily newer buildings.
One of the things that you can clearly see here from the color coding is that the majority of these properties that have been vacant for 18 months or more are new deliveries. They're projects that were built. They're the red dots, which were built, since 2020. This is showing the counties in the U.S. that have the highest numbers of these buildings, and breaking each one of them out by their age. And I think that the two that really stand out, which I'll highlight in a second, are Dallas County in Texas and Maricopa County in Arizona. And again, these are huge counties, so that partly contributes to why they're ranking number one, because they're just very large land areas and very large real estate inventory.
So let's dive in a little bit more into the Dallas-Fort Worth market.
Where you find a lot of these buildings is in Southeast Dallas, in areas like Lancaster and Wilmer, Texas, where there's been a lot of new construction. And just as I said, at the macro level, there's been impressive demand growth among tenants moving into this area, but it's just been simply outpaced by the number of projects that have delivered.
And then next over to the Phoenix area.
Maricopa County actually has, among these buildings that have been vacant 18 months or longer, it actually has the most, if you're just looking at buildings built since 2020. And you can see that here with it's all red dots, and it's primarily in, Phoenix's West Valley, where there's been, again, a ton of demand growth among tenants taking space there, but even more new construction.
Adrian also made a great point about how many of these developers have done quite well over the years, so they're not necessarily hitting the panic button just yet.
One thing I want to emphasize is that overall, developers have done really well in a lot of these counties over the, if you're looking back over the past 5 years. They've completed waves of projects that delivered in 2020, 21, and 22 that have leased up very well. So in some ways, they've been kind of playing with house money on this last round of developments that came in, towards the middle and part of the cycle. So this doesn't necessarily mean that this will cause a lot of distress at the company level, but it does mean that these properties have been sitting vacant for a long time, and based on the amount that you see accumulating in some of these places, they could easily be vacant for another year or two or longer, unless there's some kind of reset on the debt or the value of these buildings that allows them to significantly undercut the rents of the other buildings that are also sitting vacant nearby.
An important point to note is that new construction has been trending downwards.
We know for sure that the amount of new construction deliveries that's hitting the market, and that's been what's been driving vacancy up the past few years, we know for sure that that's going to slow as the year progresses and get to really low levels by the end of 2025 and 26. So that's one trend in the market that should help vacancy stabilize and potentially come down. The thing that's harder to predict is what are absorption and leasing going to be like, and that'll determine how quickly vacancies actually peak and start to come down. There's a lot of there's been a visible uptick in leasing activity in December and January post-election. However, there was also a very visible pullback in leasing in October and November with the ILA port strikes and folks just wanting to wait and see how things played out with the election before making big lease decisions. So it's unclear yet whether the bounce back that we've seen in December and January is really indicative of the fact that we're just kind of off to the races and we'll see demand, continually pick up from here, or whether that was just picking up deal volume that was stalled during October and November. To be honest, the numbers that I'm seeing so far indicate that it was more the latter. And so the big question that I'm going to be watching is how fast is tenant demand accelerating? And, once we start getting into February, March, and April, if we're still seeing this pickup in leasing, that'll be a good signal that, okay, the strength that we've seen at the very end of 24 and the beginning of 25, it wasn't just kind of deals that were stalled in the previous fall getting pushed forward, but it's more about an overall pickup in momentum, and that's what we'll really be looking for. But there are a lot of reasons to be cautious about. I think demand is going to improve, but there are a lot of reasons to be cautious about whether it's not that it won't be explosive. Mainly the fact that mortgage rates are still 7%, and housing construction is falling, and home sales are still at great financial crisis lows. So that's a big contingent of the tenant base selling furniture and home goods type of materials that's going to be pretty constrained in terms of their ability to expand until that situation changes.
Face rates might stay elevated, but that doesn't mean landlords aren't being creative.
There's only so far that they're going to that they're going to lower rents, but there is more leeway on concessions. And that gets to that question that you asked earlier. Part of the reason for that is that you can offer a pretty hefty, concessions package on a 10-year lease with free rent and TIs while still keeping a relatively strong face rent. And that, which will have, when you go to appraise the value of that property, that'll create less of a negative impact on the value of the building. It's the same. It's similar to what's happening right now in the office sector as well. So you may not see the face rents coming down in some cases. I mean, they are coming down modestly, actually, in a lot of these really heavily built out markets over the past year or two. But it's really on the TIs and the free rent where I think you'll see the give, if there is any.
Even with the pressures in the market, declining construction starts could actually lead to shortages once the existing inventory gets absorbed.
They've definitely been pulling back. Actually, since late 2022 was when the construction starts really peaked, and it's been a consistent downtrend. So that's been going for over 2 years now. And we did see starts tick down even further in the second half of 2024. And I don't know how much additionally they will move down, but let's just say that I'm not expecting them development starts to tick up in a significant way in the near term. They're at about 10-year lows right now. So the level of starts that you're seeing in the market today is roughly equal to what you saw in 2013, 2014, really coming out of the great financial crisis.
There'll be some short-term issues to work through in big box warehousing, but let's contrast that to small bay industrial. And again, the definitions can vary, but I'd generally say that spaces of roughly 2,000 to 3,000 square feet are small bay, and they'll commonly be part of a bigger property. For example, here's a building with 20 small bays. These properties are much more expensive to build as each bay has its own washroom, overhead door, HVAC system, office area, separate plumbing and electrical power, and so forth. It all adds to the cost and ultimately requires a high lease rate to justify.
Yeah, it's a totally different dynamic in the small bay world, and the small bay, even mid bay, especially in infill type of properties, are really not they're not having this issue, because even though leasing for those buildings has slowed somewhat over the past year or two, there's just been so little built that in most markets, when any tenant goes on the market for space, they just don't have very many options. And so that's keeping the market tight. And that's actually one of the reasons why, people, when they point to how well industrial fundamentals have held up relative to the other property types, one of the things that you can look to for that is CMBS delinquencies, which are, the delinquency rate on CMBS loans is well below all the other major property types, and it's barely inched up. But a big part of that is because those are primarily loans for, Class B, smaller infill properties that are doing the best in the industrial world right now, and where the financial losses are happening is more in the big box construction end of the spectrum. But you wouldn't see that show up in the CMBS delinquency rate because none of these construction loans for these big developments are CMBS loans.
And the average small bay tenant just isn't interested in paying a large premium just to be in a newer building. So the inventory of these small bay buildings hasn't increased much, even though demand has been quite healthy. So the key takeaway here is that high-level data isn't overly meaningful for the average landlord, tenant, or investor. It might be helpful if you're trying to establish a very general trend, such as noticing how national vacancy might move up or down over time, but there's a significant difference between the national vacancy rate for industrial real estate and the vacancy rate for a 10,000 square foot building on 2 acres of land in your market. Just as there's a big difference between a 2,000 square foot bay and a 1 million square foot distribution center. If you want to hear more about this topic, check out this video for an interview with Trey Pennington from CBRE, where he provides a ton of great insights into big box warehousing and small bay industrial.